When an options trader is net short time premium, as most options neutral trading strategies are, the passage of time is the trader's friend. Well, I have some news for you. Time always passes and never stops marching on, so it really should not be a big surprise if a market neutral options trade finds itself in a profitable position when the simple passage of time is enough for it to get there in the first place. Let's say, for example, that you've initiated this trade in TLT, the ETF for the 20-year Treasury bond. One of the traders on our desks likes to trade butterflies in this ETF based on some backtesting and analysis work that he did on the subject. To make this trade work, you have to be willing to tolerate as much as a 30% drawdown before exiting, which is a lot. On the other hand, when the trade's working, the trade can hit a target of as much as 30% as well. Incidentally, on any strategy that has a potential drawdown of 30%, you cannot even think about putting all of your capital into such a trade. That's just way too dangerous, but that's a discussion for another day. Getting back to the TLT trade, this trade, upon initiation, has a capital level of $56,000 on it, so the trader's target is 30% of that, which comes to about $16,000. As you can see, the trade has the theoretical potential of making over $70,000, but the target profit, according to this trader's protocol, would be a bit above $16,000. For trades that can draw down this much, it's imperative that the trader have the discipline to avoid prematurely taking profits. After all, there will be months where the trader will be stopped out and take a 30% loss on the trade. If the trader doesn't have the discipline to allow trades to mature into profit target trades, he'll never be able to recover from the months where he gets stopped. So, for example, on May 2nd, the trade had appreciated to a gain of $4,100, which is not even a 7.5% gain on the trade versus the target of 30%. But if the trader had panicked and tried to protect the minor gain on the trade, he ends his ability to achieve a much greater profit in a strategy that needs those greater profits for the return numbers to work. So, for example, if on May 2nd the trader had entered into this transaction, the trade goes from being a 256 lot butterfly to a 40 lot. Well, the trader has certainly turned his trade into a no-lose proposition. The trade cannot lose now. The worst that can happen is that the trade makes about $600. The problem is that he has also effectively ended the trade. If you have the greatest luck in the world and TLT expires exactly at 118, you would make another $500 out of the trade. The reality is it almost certainly will not exactly expire at 118, so while you may feel better by locking down the profits, you've done yourself a great disservice because essentially you can't make that much more on the trade at this point. So now let's move forward to May 14th. The trader who locked in his profits now has a P&L of about $900, whereas had the trader been disciplined and not tried to lock up his profits too early, the result would have been a P&L of $11,000 that day. This is a good example of where you may feel better by locking down profits, but by being so hung up on protecting smallish profits you make early in a trade, you forego the significant profits that you can make later in the trade. If you take your profits too early on a trade, you won't make the returns that you deserve to make given the risks of that particular strategy. In other words, you'd be cutting your profits short and letting your losses run. The exact opposite of what any good investor or trader does.